Imagine having a crystal ball for your business. A way to see if that brilliant growth plan of yours is going to be a huge success or if it's going to run you out of cash. Well, that tool actually exists. It's called a financial projection, and today we're going to build one together.
All right, so let's set the scene. You've got this amazing plan to grow your business next year. You're thinking bigger sales, new customers, everything's looking up. It's a super exciting time, right?
But here's the catch. How do you know you'll have enough cash to actually pull it off? Growth costs money. And honestly, this is the exact problem that trips up so many otherwise fantastic companies.
So let's find the answer to that critical question. We're going to walk through building a financial projection step by step and get a real glimpse into your company's future.
See, growth isn't free. You have to buy more inventory before you can sell it. And you have to pay your bills while you wait for your customers to pay you. Projections are how we stress test our plan to see if we've got the resources to handle it all.
Let's get into it. Part 1 is all about forecasting your company's story. Think of the income statement as the narrative of your business. We're just telling that story with numbers.
We're going to build this story from the top down. It all kicks off with sales, and from there, we'll just work our way through all the costs to see how much profit, or net benefit, is left at the very end.
Okay, first things first, sales. Now don't worry about reading the tiny text here. The idea is super simple. We take our current sales, say $1,000, and we apply our expected growth rate. So with a 25% growth plan, our new sales projection is $1,250. That's it. All right, what about our costs? Well, the key is we don't guess, we look at our history. And what's interesting here is that this company's gross margin has actually been shrinking a bit. So the most realistic thing to do is use the most recent number, 30%, for our projection.
And we use that exact same logic for other expenses. Historically, they've been around 16% of sales. So we take that 16%, apply it to our new sales projection, and boom, we get a projection of $200 for indirect cost. See? The past is our map for the future.
So this diagram really pulls it all together. We start with our sales growth, and then we just use historical percentages to fill in all the costs and expenses. Each line just flows right from the one above it, giving us a full story of our projected profit.
Awesome, we forecasted the story. Now, for part 2, this is where the rubber meets the road. We need to figure out what resources, what actual assets we'll need to make that story a reality.
And this is the crucial link. This is so important. The income statement we just built and the balance sheet are completely connected. The activity we just projected tells us exactly what stuff we need to have on hand to make it all work.
Let's break that down. The more you plan to sell, the more accounts receivable you'll have. That's just money you're waiting for from customers. The more stuff you sell, the more inventory you need to have sitting on the shelf. And of course, the more payments you have to make, the more cash you need in the bank.
And that all leads us to the grand finale of our projection, Part 3, Finding the Financing Gap. This is the moment of truth. This is where we compare what we need with what we have and see if our growth plan is actually viable.
This diagram lays it all out for us. On the left side, you've got all the assets you'll need for growth, like cash and inventory. And on the right side, you've got the financing you already have lined up, like existing loans and the owner's investment.
So whenever that left side is bigger than the right side, we get what's called a financing gap. This is the number we've been working towards this whole time. It's the exact amount of new money you need to find to make your plan happen.
Let's put it as simply as possible. The left side of the sheet is what you need. The right side is what you have. And that difference between the two, that's the gap you need to cover. Probably with a new loan or by bringing on investors.
But hold on, we're not quite done. There's a little twist. This annual big picture approach is great for a lot of businesses, but it can be super misleading if your business is seasonal.
Just think about an ice cream shop. If you build your whole annual projection based on a busy month in July, you're going to think you're swimming in cash. But if you base it on a slow February, you'll think you're going broke. A yearly average just hides the real story of those peaks and valleys.
So, what's the solution? It's actually pretty simple, but it's absolutely vital. For any seasonal business, you have to project everything month by month.
So instead of just one column for the whole year, you make 12, one for each month. This lets you see exactly how your need for cash changes, so you don't get caught in a cash crunch while you're stocking up for your busy season. It's the key to surviving the entire year.
And there you have it. You've projected your income, you've calculated the investment you need, and you've found your financing gap. You now have the single most important number for your business's future. So the only question left is, what's your plan to close it?